Does the potential for dropping interest rates create an incredible opportunity for real estate investment trusts in 2024? Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And this will be part 10 of my 11-part series going over all the other sectors, all the 11 sectors, excuse me. Now, I've been talking about REITs, or real estate investment trusts, quite a lot here, even prior to doing this series. So I've got links to 3 videos I've recently done, one on Realty income, one I titled Are Office REITs Good Investments, and one that I titled Is Now the Best Time in Decades to Invest in REITs. So I encourage you to go look at those. But what I did here, like I did with all the other 10 sectors, I created a screen. So let's go ahead and look at our screen that we developed, and I came up with 34 companies. Now, I want to briefly go over the screen with you. Number one is I went through 6 general categories. I tried to keep these screens very simple. I obviously looked at the real estate sector. I asked for primary tickers. I looked for dividend yields above 2%. And then I looked for a price to operating cash flow, or FFO, as it is with REITs, positive. I looked for an operating cash flow yield greater than 6%. And an operating cash flow persistency, or FFO persistency, of moderate of greater than 6%. And on the historic section, I screened for companies that had positive FFO compound annual growth rates. And then on my estimate screens, I had 2 screens there. I screened for operating cash flow total return greater than 5%. Which was, rather low. And then I did operating cash flow growth that was positive. Okay, again, very simple screens. And then finally, I did U.S. and Canada as far as regions go. So now when I ran the query of this screen, I came up with 34 names. Now, it's obviously too many to cover in a video like this. So I've converted that into a portfolio. And then I deleted stocks that I didn't necessarily want to try to cover. And I came up with 10 companies, 10 real estate investment trusts, 1 office REIT, I think the best of the breed, Alexandria Real Estate, Camden Property, which is a multifamily residential, CT Real Estate Investment Trust, which is a retail REIT, Information Services Corp, which is not a REIT, it's actually a real estate services company. So I did, want to cover the real estate sector. And then I did Killam Apartments, multifamily. I did Mid-America Apartments, which I think is one of the highest quality multifamily residential REITs. Morguard North American Residential REIT. NNN Realty, which is a retail REIT. Plaza Retail, which is a retail REIT. And UDR, which is a family REIT. Now, as far as regions are concerned, I've got 5 Canadian companies here for our Canadian friends and 5 U.S. companies that I'm going to briefly cover. Now, I'm going to go through these in alphabetical order, just because it's easier and simpler to keep track of where I am on the portfolio. So I'm going to start off with Alexandria Real Estate Equities. Now, I'm only going to focus on really 4 of these REITs out of these 10. I'm going to show you all 10, but I'm really going to only focus on all 4. And I have reasons for doing that, not just because I think they're the best investments at this time, but because I also think they have great value in helping us understand valuation and how to invest better in the long run. So starting out with Alexandria Real Estate Equities Inc., I want you to note that coming into the recession of 08 and 09, this is an office REIT, the only one that I'm going to cover. Again, I did another video with there's a link to. And as we came into the recession of 08 and 09, we did see some funds from operation drops, and we even saw a dividend cut, for a period of time where the dividend got down to $1.50 a share. But I also want you to notice that since that time, this has been a very consistent real estate investment trust. It's grown at over 6%. Even through COVID, it maintained its growth rate because this company, and I'm going to feature this one a little bit. So this company is a company that basically deals with what I'll call office space that's actually in high demand. So if we go into About Alexandria here, the company was founded in 1944. Over the past 20 years, they've established as the leading owner, operator, and developer of collaborative campuses for life sciences, ag tech, and advanced technology companies. So a little different than the average office REIT that might just have, every kind of little business you could think of. This is an office REIT where the tenants actually maintain office space and their employees do have to work in the office. But because of the quality, the company's BBB plus and only has 39% debt. That's one, below an A-rated REIT, and there's only a handful of A-rated REITs, but this is one of the higher quality BBB plus with moderate debt for a real estate investment trust. You can buy them at a price to funds from operations of 14.3. That gives them a 6.9% FFO yield and a 3.92% dividend yield. Remember, REITs by law have to pay out the majority of their income that is disposable. So what I really want to focus on here is how highly valued the market has valued this. Now, this is something I'm going to be talking about more and more, and that is the difference between the value of the business and the price of the stock. Now, a formula for a 6% grower, even with all these attributes, would technically indicate that a real estate investment trust like Alexandria ought to be trading at about 15 times FFO, and that would be an earnings yield of 6.67%. But typically, you can see, especially since 2014, now in 2012 and 13, they did trade at a 15 multiple or, hovered around a 15 multiple. Then starting in really February of 2015, they traded at a much higher multiple of about 19. That's the blue line on this graph. That's a price to FFO of 19.31. But they've been a very consistent grower and a very consistent dividend payer over this time frame. Now, buying it at an attractive valuation of 15, a little more, price to FFO here is 15.57, and holding it to where we have a 14.3, so we got a little bit of PE ratio contraction. We still earned 8% on our money. We ended up with $6,183 in dividends based on a $10,000 original investment. I got 62% almost of our money back, and our $10,000 investment grew to $19,000, and that's with the REIT being undervalued. Now, you can see that after, with the talk of interest rates, had several impacts. One is this stock was vulnerable because it was highly overvalued, in my opinion. It was well above even the blue line in 2020, 21, etc. Then 22, we saw a pretty good correction back to where it almost hit fair value. It went below its historical normal PE and got attractive. Then in 2022, it stayed hovered around this with a lot of volatility. And then in 2023, as interest rates continued to rise, we saw the stock price fall dramatically. Now, I do want to emphasize this price drop was about a 47, or we'll say that, the stock was just about cut in half here. If I timed it better, it probably was cut in half. Now it's recovered dramatically and it's moving back into fair value territory. So when you can get an opportunity to buy a REIT of this quality at undervalued levels, you can obviously enhance your rate of return by getting PE ratio expansion as well as growth, as well as a nice, roughly 4% dividend yield. At this point here, we were getting over a 4% dividend yield. I want to make that clear. So this is Alexandria Real Estate. Looking at the future for this company, analysts expect more of the same, continue to grow at around 6%. And that's, kind of consistent with what its historical growth has been. Next REIT on the list would be Camden Property Trust. Now, they did pay a special dividend one time here, but again, we have the similar story. This is an A- rate with only 39% debt. It's a multifamily residential REIT. It did, pay out a real nice special dividend once, but otherwise the dividend has been very consistent. And once again, we see the vulnerability of high valuation. And I want to make another point here. The stock market does not always price stocks correctly. If you don't, embrace that idea, then you'll never be a successful investor, in my opinion. And it doesn't matter if you're a value investor or not, like yours truly. Point is, you need to be able to recognize when markets get, crazy with valuation. In this case, we saw Camden get up to a 33 times price to FFO by December of 2021, which was a ridiculously high value. Now, the company did have a couple of good years of growth here, way above average, a 10% growth and a 22% growth. But again, investors got a little bit overly zealous. And then, of course, as interest rates increased, we saw a rather large correction. And this is a correction, again, from overvaluation. That's going to become important later on, because here again, we saw about another almost 50% drop in the value of the REIT, but we saw it fall from being overvalued to fairly valued. Again, it's trading at a 14.59 PE today, FFO yield of 6.85, and it's over a 4% dividend yield. This is not as attractive an entry point as it was just a few weeks ago or a few months ago, but I think this REIT is still reasonably priced, especially considering that the market has historically put a premium valuation on it. Next REIT I want to look at is another Canadian REIT. Now, I showed this one only for one reason, to help those of you who are subscribers to FastGraph understand how to use this tool. If I go to the graph key here and look at the FFO growth over this period, I see it's 18.5%. But by looking at this picture, I recognize that that's not an accurate number because we had this real anomalous number in the first year when this company just first went public, okay? So what I'm going to do is I want to call that year out, get rid of it, CULL, call it out. And what I get is I get about a 3% grower. Now, I do have a 6% dividend yield and a very consistent dividend rate. And if you'd have bought this, initially at about a 12 PE, it's around 11.3 now. With a 6% dividend yield, you would have averaged 6.5%. You'd have got half your money back in dividends and a slight profit, and that's with the REIT currently being undervalued. And by the way, with FastGraph, you can go into external links and go into the corporate website, and you can learn. This is another Canadian REIT, and you can learn about, the properties they have, and you can do your due diligence. I'm not recommending any of these now because I've not done full due diligence on most of them. I'm giving you the opportunity to do it yourself. But this is a steady, consistent, BBB rated, 54% debt, which is reasonable, with an FFO yield of over 8.5%. That's the real allure here, is the fact that it's got a margin of safety with the valuation, even with a normal, lower than justifiable, I should say, valuation. The normal price to FFO has been 13. So if it just went back to the 13 price to FFO, I want you to see you could average over 16% or more than double what it's historically returned, simply because the stock is undervalued today. The next name on the list is Information Services Corp. Now, here we're looking at operating cash flow. This is not a REIT. This is a Canadian company that provides information services. And once again, I don't know a lot about this stock, but you can go into the company's website and, you can learn what the company does. They say the world revolves around information, and ISC is at the forefront of information management services and solutions. So you can go in there and read a lot more and learn about it. I like to look at this one from an earnings point of view. And I find this one very interesting because you'll notice here a period of dropping earnings, but still very profitable, but, no growth for this period of time. And I want you to note the stock, really kind of was level during that period of time. Then, we had a little bit of growth. And of course, we hit COVID, which, interrupted that price a little bit. But then the company put together a couple of years of positive growth, 6% in 2020 coming out of COVID, followed by 51%. And once again, we see the price run up dramatically. There is a lot to say about, overvaluation caused by extremely attractive operating results. But then as operating results once again have begun to falter for a couple of years in 2022 and 23, we see the stock price tracking that. But this stock looks interesting now based on forecasts of very strong growth for the next couple of years. It trades at a blended PE of 16. That's just a little higher than I'd like. It's got a dividend yield of 3.96%. It's not rated. It has about 61% debt, but this would be an interesting one for you to do due diligence on if you're looking for a decent income provider with some growth potential. The next one is another Canadian REIT. This is a apartment REIT. Again, we're going to look at it from a funds from operations point of view. I'm going to go ahead and expand this out here because, again, here's another lesson in using the tool. We got 7.5% growth here, but we've got an anomalous number. So let's get rid of that anomalous growth rate. And what we find that this is about a 4% grower. And looking at forecasting, it's expected to grow at 5.91% with 13 analysts following the company. So that's kind of more of the same. But once again, I want you to see the impact of valuation. First of all, let's look at undervaluation. We saw that in the 08-09. This is a multifamily residential REIT. And we saw, this was obviously a financial instigated recession. And, we saw lenders getting in all kind of trouble, a lot of financial stocks. We got down to a 6.61 FFO. This is when the stock was clearly undervalued. Again, the lesson here is just because the price goes down does not mean the business hasn't done well, okay? And so if you'd have bought it at that point in time, you'd have made over almost 13% a year. Your market value would have quadrupled over this period of time, and you'd have got more than twice your original investment back in dividends if you bought it in December of 08. But I also want to make a point, by buying it when the priced FFO was so low, you didn't have to wait that long. You more than doubled your money just in the next couple of years and got almost 40% of your money back in dividends. Now, on the flip side, we also see the deleterious effect of high valuation. When the valuation got real high here, even though the business didn't perform real well, okay, so that's made it vulnerable at that high valuation. We see that the stock really didn't do very well. You had negative rate of return for 3 or 4 years, although the business itself did okay. It didn't grow, but it maintained a healthy profit profile and then began to grow again. And as it began to grow again, we all of a sudden saw these high valuations. And every time you see a high valuation, I want you to notice that you see a vulnerability. Today, the stock is, what I would call fully valued or fairly valued. The PE is a little bit above 15, a 6.3% earnings yield. I like 6.67. It does offer a 3.84% dividend yield, and it only has 37% debt. And this is an apartment REIT in Canada. And once again, I think this looks like a very interesting REIT if you can buy it when the valuations get low. And if I was right today, I think the stock was down a little bit. Bottom line is this REIT really shows us some great lessons on valuation. And the next REIT I want to show is Mid-America Apartment Communities. Again, I want to feature this one a little bit. This is an A-rated REIT with only 38% debt. It's a multifamily residential REIT. And again, we see such an important lesson in valuation. Low valuations are the best time to buy any stock, real estate investment trusts especially. And then we had this, huge high valuation that REITs had. And then as interest rates, began to rise again, we saw that vulnerability. And now I would call this REIT fairly valued with a 4.4% dividend yield. It would be a good potential long-term investment here, but not as attractive as it was back in 2013 when the priced FFO got down to 12, or even better yet, in March of 2009 where the FFO got down to 6. When you can buy stocks at these kind of discounts, that's where you can really generate really strong rates of return over the long run. Not necessarily very quickly or immediately, but over the long run. Then the next one we're going to look at is Morguard North American Residential REIT, another Canadian REIT. I liked showing this one just because it was just very consistent FFO growth. If I take out a couple of really good years there, you see it's been about 3.8%. Forecast is for growth to be about 2.5%. The potential rate of return would be very high if it gets back to a 13.43 PE ratio based on a 2.5% growth rate using the Graham-Dodd formula, or its normal PE of 14, which was a little higher. This one, for the last several years. So, you're looking at a REIT that is very, very undervalued right now. It has almost a 5% dividend yield, 4.87%. You can buy it for less than 10 times FFO. It only has 42% debt. I think that's, very attractive. The next one, we're going to look at NNN. Again, I'm going to expand this out. Great lessons in valuation here. Very consistent REIT, BBB+ with about 50% debt. This is a retail REIT, and once again, you can go in, if you're a FastGraphs subscriber, right into the corporate website, and you can, look at their portfolio of properties and do your own due diligence on these REITs. But this is very consistent. You can see it got very inexpensive in the height of the interest rate mania, and then it's been recovering and moving back into alignment with fair value. It's still inexpensive at a 13.5 PE, FFO yield 7.39%, and a dividend yield over 5%. This one could be attractive. The next one is, again, another Canadian, Plaza Retail. It had a couple of down years of earnings, and the stock did react to that, but you can buy it very inexpensively here with a dividend yield of over 7%, and it's not a fast grower. attraction here is the low valuation and the high yield. And then last but not least, we're going to cover UDR Inc., which is a multifamily residential REIT. And once again, we see the impact of the financial recession. But if I look at this, since the Great Recession has ended, you can see just coming out of that. This particular real estate investment trust has commanded almost a 20 multiple historically. They got overpriced. It's very inexpensive now. It's been about a 5% grower. It's expected to grow about the same, 4% going forward. If you look at the normal multiple of 20, it would be real attractive today. But on a more conservative basis, a 15.6 multiple puts it, squarely in the fair value range or fully valued range. But it's also a very good REIT, BBB plus rated with only 55% debt. And again, keeping in mind that real estate's, investments have mortgages, that's a pretty good level of debt for it. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation, bringing you this kind of update on REITs. This was part 10 of my 11-part series. But I'm going to do something else special here today. Everyone's going to note, and I'm probably going to get comments, what about MPW? How come I didn't cover that? When get an update? So I am going to do another video here shortly where I'm going to give you an update on MPW, which just fell 29 to 30% a day or so ago, and give you my thoughts on MPW and also some additional thoughts on valuation. So, look for my part B to the real estate investment sector coming up. Thanks for watching. I hope you enjoyed this video. If you did, give me a like, subscribe to our channel, and take a look at FastGraphs, the fundamentals analyzer software tool. What a great way to analyze investments and understand better the business behind the stocks you're investing in. Thanks for watching. Talk to you again soon.